Okay, hello everyone, and welcome to today's virtual lecture on building machine learning trading algorithms with high frequency market data. I want to welcome Marius Zoican, who is the professor, and he'll be leading this lecture. And I also want to welcome Dr. J. Ari Pandis, who is the Associate Dean of Graduate Studies here at the Haskayne School of Business. This is a series of lectures that we are starting as Calgary grows with its status as a financial hub in Western Canada, and as we launch our new Master of Finance program, we want to bring these kind of lectures to the community, just to give you a sense of what the Master of Finance looks like, what the financial world looks like, bring you some new concepts, and hopefully get more people interested in the finance and fintech sector. So I'm just going to hand it over to Ari, and Ari is going to say a few words before we get started with the lecture. So thank you, everyone, and thanks, Ari.
Thanks, Nikhil, and thanks everyone for joining. As Nikhil was mentioning, my name is Ari Pandis. I'm the Associate Dean of Professional Graduate Programs here at Haskayne. And under my portfolio also will be the Master of Finance. This program in particular is near and dear to my heart, not only because I'm a finance professor in the finance area here, but I was the area chair actually when we started thinking about bringing the Master of Finance forward and putting the proposals through. And so it's been a labor of love. It's been several years in the making. And we were excited last year when it got approved by the government. And one of the things that we noticed early on when we were researching Master of Finance programs is Alberta is really starved of a Master of Finance. I mean, you look across the country and pretty much every province has a Master of Finance except Alberta. Yet we've got one of the biggest financial markets in the country, and it continues to grow at breakneck speed, particularly the fintech sector. And so that's an area in our finance group where we've got a really strong cluster of academics, Marius being one of them. He's a Canada Research Chair. We poached him from Rotman at U of T, and we're very excited about that. He's been a really good welcome addition to our group, and it continues to grow as well. And so one of the things that you'll find with our Master of Finance is we've placed it kind of in a unique position. I mean, across the country, if you look, you've got some that are really CFA targeted and oriented, preparing you for that. At the other extreme are mathematical finance programs where you don't have as much of the financial and economic intuition. So we really wanted to sort of place ourselves in between where you're getting a lot of practical insight, relevant education through the program. But it's also rigorous where when you get into the workplace, you can really make an impact and hit the ground running. And so we're excited about the launch. It's launching in September. If you'd like to learn more about it, it's a 16-month program. A full-time program. If you'd like to learn more about it, please reach out to Nikhil. He's got a lot of info to share with you about the program. And you can always reach out to me as well too. My door is always open, and as well as our other finance colleagues. But yeah, I'll keep it short. Like I said, we're excited. We've got Marius here to dive into the world of trading, high frequency trading, machine learning, and it'll give you a little bit of a teaser of the type of content to expect in the program when it launches. And we do expect Marius to teach in the program. He'll have a course that he's excited to be teaching and he's preparing for. And so this will be a nice preview of that. So why don't I hand it over to you, Marius, and you can take it away.
Thanks so much for the intro, Ari, and I'm very excited to see the great interest in the program and a number of people signing up to hear about high frequency trading and machine learning. So I hope to give a good introduction on that, and to give, like Ari said, a little bit of a teaser of the kind of material that we're going to be touching upon in the Master of Finance, and especially my course on quantitative investing. So again, as Ari was mentioning, this is a very hands-on program. So what I prepared for you today is not a set of slides, but rather a Python notebook where we can look at data in real time and do some analysis. Please feel free to jump in with questions if you have any. And I'll try to keep it very practical and very interesting. So the topic of today's lecture is how to go from market data to predictions, going through these machine learning algorithms. And when people think of markets, they have something like the Wolf of Wall Street trading floor in mind. That's not really how markets look like nowadays. They look more like this picture over here, which is server room somewhere in New Jersey or in the suburbs of Chicago, where essentially you have trading bots interacting with other trading bots and algos, and that generates a vast amount of data. Every day, a contract would generate millions of events. And by events, I don't only mean trades, I mean people putting in orders to buy, to sell, canceling those orders. So there is a vast amount of data, more than you can process in an Excel file, for example. The good news is that this is processing vast amounts of data are what computers are really good at. And what machine learning is all about. So now we can leverage sophisticated mathematical techniques to actually, try to predict where the prices are going to go next at very, very high frequency, milliseconds, nanoseconds. And if we can predict just a tiny little bit better than 50-50 where prices are going to go next, we can generate alpha. We can get perhaps some profit without taking a lot of unnecessary risk. So when you're thinking about quantitative investing, when you're thinking about algo trading, machine learning, you don't really have in mind the type of events that really move a company, like the CEO has been fired, or there was an earnings announcement, or things that occurred daily, weekly, quarterly frequency. You really have in mind just looking at order book data, looking at what people are trying to buy, trying to sell, looking at volatility, and having a lot of data trying to extract a tiny little bit of value. And if you do it frequently enough, it adds up. And companies like Citadel or Virtue in the US, they are relying on this mathematical heavy business models. And in fact, Virtue, within 5 years, with the span of 5 years, they had only one losing day. So these strategies can be quite solidly profitable. So what we're going to do today, we're going to load some high-frequency trading data. We are going to wrangle with it and try to build some measures of volatility, of spreads, of returns. And then we're going to introduce a couple of very simple, very straightforward machine learning, econometric, statistical models, and trying to see whether we can beat the market, whether we can beat a simple buy and hold strategy where we're just holding that product for a couple of days. I'm not going to go very deep due to the time constraint. I'm not going to go very deep into the actual code. We're going to do that in the program. We're going to go line-by-line programming in real time, interactive, lab-based lecture. Today, I want to give you a taste of the kind of tools we can use and how it's going to work. What I'm going to do first here, I'm going to use Python as a programming language. I'm going to import here some libraries. Libraries are just collections of functions that allows me, for example, NumPy will allow me to do mathematical operations in Python, stuff like logarithms, like square roots, which I need for volatility. Pandas will allow me to work with databases. And something that's very important, DataBento, it's our data vendor that we've been working off multitude of courses here at Haskayne, and just gives us access to real-time data for very, very cheap prices. So I was thinking, okay, what kind of asset we're interested in looking at today? And there's been a lot of discussion around precious metals lately. So I'm going to look at a silver futures contract that's traded on the Chicago Mercantile Exchange. And I'm going to look at the most liquid silver futures contract, the February 2026 one. And I'm going to load market price data, and it's going to take about 30 seconds or so. So on DataBento, which is our vendor, you can have multiple types of data. You can just look at trades. You can look at daily summary stats. You can track every order when it was reaching the market and when it expired. But you also can look at basically the market by price, which gives you all the trades and all the updates to the best bid and ask in the limit order book. So we're going to load it, and it actually loaded. This is the API key. This is my password to access data bento data. And I'm going to create a command here to get the data from the data bento server. I have to specify where the data is coming from, and this is the Chicago Mercantile Exchange ID. What am I looking for? And this is the silver futures with expiry in February 2026. What kind of data I want, market by price, and a start and an end, right? Because I cannot look at the yearly of this data, a year of this data. It's a lot of data. I'm going to look at 4 days from January 11 to January 15. And once I load it, I can see I have for this 4 days, I have 10 million records. So silver futures about 2.5 million entries a day. And I'm really capturing everything. And you can look here, look at the timestamps. And you look here at a lot of numbers after the second. So we're capturing everything with nanosecond precision. You can see an action where the order was added, when the order was canceled, the side, whether it was on the bid side, on the buying side, or on the ask, on the sell side, the price, the size of the order, and for each order, you can see what the prevailing bid price and ask price were. And for those of you who maybe not know what bid and ask prices are, the bid price is the price at which you can sell a security, and the ask price is the price at which you can buy the security, and usually the ask price is higher than the bid price. So, you're buying more expensive than you're selling. And you see here, for example, the quantities available at that price. If we're trying to sort of group them into what kind of actions happen in these 4 days on the market, you can see that, trades, you just have under 1 million, and that's not where the action is in a lot of things. When you're thinking about high frequency data, the action is really in adding orders and canceling them very quickly, trying to do price discovery by posting limit orders, then seeing something change, removing them, posting them anew, and that's how prices mostly adjust. Trades are a little bit of a sideshow, but for the point of today's lecture, we want to keep it sort of a bit self-contained. So I'm going to look at trades, and I'm going to extract some information based on trades. So I'm going to look at my database, only look at those rows that actually indicate a trade, and then I'm down to 934,000. And just to sort of see how the silver price look like, I can show you a quick plot. So you can see that if you bought silver futures January 11th, and then you held it for 4 days, you actually would have made quite a bit of money for 4 days. So the price is going up. There was a lot of debate around precious metals in this time span. So the goal today is to see, well, can I devise a strategy that's actually going to make more money than me buying silver here and holding up until here? And to do that, we're going to leverage some machine learning methods. Now, even working with 900,000 timestamp observation might be a little bit too noisy. So the first step in sort of getting to the core of this data is to aggregate it a little bit. The way we're going to aggregate it is we're going to build rows corresponding to every minute on these 4 trading days. And in particular, I'm going to look at open, high, low, close volume bars, whereas the open will be the first trade price in that minute, the highest trade price in the minute, the lowest trade price in the minute, the trade price at the end of the minute, and then the volume, how many contracts have actually been traded. So I'm trying to group that into sort of constant time bins, because trading activities generally comes in bursts. So if I look at trade by trade rather than minute by minute, I could sort of like overemphasize some periods of time and de-emphasize another ones. So I'm going to take my trades data, I'm going to take the price, I'm going to resample it at every minute and compute all of these. And that's a single function in Python. It's a single line of code. Then the volume is going to be the sum of all the trade sizes. And then I'm just going to count the number of trades. Once I have that, I can compute the spread. The bid-ask spread is the difference between the ask and the bid price every minute, taking the average of that. The bid depth, which means how many contracts are sitting on the bid side of the book, how many are available for sale. I'm going to take the mean of that every minute, and on the ask side of the book, how many contracts are available for purchase. Again, taking the mean. And I'm going to drop any sort of non-available value to keep my data nice and neat. And suddenly I am getting a very neat table where every row here is 1 minute. I'm getting the first price of the minute, the last price in the minute, the highest and the lowest, how many trades I had in what's the trading volume in that minute, the number of contracts, how many individual trades I have, and then some measures of liquidity. And I don't have enough. Right? Machine learning models are very greedy when it comes to data. So I need to put in a lot of features. I need to put in a lot of variables to help me predict returns. So just having the spread and the depth is not really going to cut it. So let's add a little bit more. Let's add returns. Right? Previous returns might explain next returns. That makes sense if you believe in momentum or mean reversal. Volatility, I want to see how much prices have been moving in the past couple of minutes. Maybe expand a little bit on volume and order imbalance. So I'm going to basically copy my original data frame into a new object df. I'm going to compute the return in every minute as being the last price of the minute minus the first price of the minute divided by the first price. I'm going to compute lag returns, the return in the previous minute, the return 2 minutes ago, 3 minutes ago, and the cumulative return over the past 5 minutes. Compute volatility, and I want to get a simple definition of volatility here that I can compute minute by minute. So I'm not going to look at the standard deviations of returns like some of you might have been used to. But they're really going to look at the range of returns as a measure of volatility. So basically, how far away were the highest price and the lowest price in any given minute? If the highest and lowest price were very far apart, that means the price had been quite volatile back then. And I'm going to normalize this by the opening price of every minute. And then again, I'm going to lag it, and I'm going to compute the rolling volatility, which is sort of the more traditional standard deviation of returns over the past 10 minutes. I'm going to do some more transformations for other variables. For example, volumes. Volumes tend to be really, really large numbers. So coefficients, if you're estimating regressions on large numbers, the coefficients tend to be a little bit less reliable. So I'm going to take the log so that everything is numerically more stable. Then I'm going to compute a volume ratio, which is just the volume in a given minute relative to the past trend, so the rolling mean over the past 10 minutes. The order book imbalance, which basically it's a measure to see whether there are a lot of contracts that are ready to be purchased relative to contracts that are ready to be sold, right? Whether people are willing to buy or willing to sell that stock at any given point in time. And then the spread, which I'm going to normalize it by the closing price. So all this is going to take me a couple of seconds. And suddenly I have a much bigger data frame, a data frame that I have to scroll over. I have 22 columns, so 22 features in some sense, which is, still quite not a lot for machine learning standards. But enough, hopefully, to have a little bite in what we're trying to do today. Okay, we have this data. We started from the big data. We aggregated it minute by minute, so eliminate some of the noise. We created new variables to reflect, liquidity, volatility, past trade transit returns, past trades and volatility, imbalance between buys and sells. So we have a lot of process variables, but what are we actually trying to explain? So what are we targeting? I'm going to go for the simplest variable that we can try to predict, which is the direction of the return in the next minute. Can I predict where the return is going to go in the next minute? So I'm going to define a new column here, which is the next return. It's a little bit of a peek into the future. I'm shifting the return one period forward. And then my target is going to be 1 if the next return is positive and 0 else. And I'm going to drop some non-available distributions and then sort of count in my data set how many targets are 0, so how many times the return went down or was flat, and how many targets are 1, so how many times the return was positive. And you can see it's about 50-50. Like there's not, even if you see the silver price going up over 4 days, if you zoom in on a minute-by-minute basis, it's evenly split. It's a 50-50%. And that's what you would expect if markets were efficient, which means people are impounding information continuously into prices by trading, by quoting. Like you shouldn't see a lot of predictability at this high frequency, and any sort of advantage we can have over 50-50 can actually translate big returns once we sort of trade a lot of times. All right, so this is how my data frame looks now. You can see here that this is going to be my next return, which is the return on the next column. So for example, here I'm sitting at 11:10 p.m. on January 11th. My return was minus 0.80%. My next return was minus 0.11. So that's what I'm going to see here in the next return column. This was negative, so my target is going to be 0. All right, so I'm going to try to predict these targets. Now, it's good sometimes it's good always to look at the features. How do they differ? Just to have an understanding of the data. How do features differ between periods when the target return is 0 versus periods when the target return is 1, and see if there's actually some difference. And this is normalized in percentage times, in percentage points. So you can see that, for example, the lag return is much higher when the return is about to go up than when it's about to go down by 46%, and so on and so forth. Okay, now we have the data that we want to use to predict things. We know what we want to predict, which is our target return, and we need to connect the two. And this is where machine learning models come into play. And I'm going to show you today 2 models. I'm not going to go into huge levels of details. I'm going to show you the logistic regression, and I'm going to show you a very simple decision tree. But these are just algorithms that you can plug into the data that you want. They all have the same characteristics. Like you have a set of features. In our case, this is going to be the lag returns, the volatility, the imbalance, the spread, and the target, which is going to be whether the next return is going to go up or down. An important thing that we need to do when we're interested in prediction, regardless of the machine learning algorithm we're using, is to split the data between a training set and a testing set. So I don't want to estimate my model on the same data where I'm going to test whether it makes money, because by definition, when I'm estimating, when I'm fitting one of these models, it's going to try to maximize its predictive power. So in a sense, if I see if it makes money for the same data that I've been estimating it, I'm I'm in self-fulfilling prophecy realm, the models is going to go well because that's the data that I use to train it. So the first thing I'm going to do, I'm going to split my data frame with all my features and my target into a training area, which is the first 70% of my data. That's what I'm going to use to estimate my models, to train my models, and then a testing group, which is going to be the last 30% of my data, and that's when I'm going to see whether my model actually performs well, actually has some sort of predictive power. All right, so if I do that, I'm going to have, remember, these are minute by minute observations. I'm going to have about 3,000, slightly less than 3,000 observations in my training set. That's what I'm going to use to estimate my model. And then I'm going to test if I can make money on 1,200 observations. Right? So roughly the first 3 days are for training, the last day is for testing. All right, so now how do I get from a large set of features that can be anything, right? They're basically real numbers, but you can think of them as being dummies, as being 0-1 variables in other contexts. And I have to convert them to basically a 0-1 outcome, whether the return goes up or down. We might think, okay, we're just going to build a regression model. But in the regression model, if all my feature, all my explanatory variables, all my x variables are unbounded, the outcome will also going to be unbounded. So the logistic regression is sort of the natural step. So what am I going to do is I'm going to model the probability that the return next period is going up. And I'm going to model it using this, I think, rather simple logistic function. It might look complicated at first step, but it's actually pretty neat, which is 1 over 1 plus exponential, negative, and then a linear combinations of all my features, right? So all my features could be spread, could be depth, could be order book imbalance, could be past returns, anything you wanted here, right? So to see why this is always between 0 and 1, think that, for example, all my x's are very, very, very large. So this number here is going to be a very, very large number. Then you're going to have exponential to the power minus a very, very large number. It's going to be 0. And then it's probably going to be 1 over 1 plus 0, which is close to 1, right? So if your score that you're getting from adding all these things up is going to be large, your probability that the return goes up is going to be close to 1. If all these numbers are going to be negative, say going to minus infinity, you're going to have exponential minus infinity, it's exponential infinity, which is infinity, and then you have 1 over 1 plus infinity, which goes to 0. So this number goes to 0. It cannot be negative, because this exponential will never go negative, and it's never go outside of 0 and 1 bound, so it's a nice probability, and it has some other features. So now my training model says, well, I need to find the appropriate betas. I need to find what should be a good beta 0, beta 1, beta 2 that will multiply my features such that I can predict the next return the best I can. So now we're going to do this in the course in the master, and I'm going to show exactly how it works. It uses a maximum likelihood technique. It's trying to get the data as close as possible to the model. But the nice thing about Python is that a lot of these things are being coded in. So we can just use another library. In this case is sklearn, and sklearn is the go-to library for any sort of machine learning model. And we're going to import some function, notably the logistic regression, a scalar to sort of compact all these variables into 0-1 intervals, and some metrics to characterize how good the model is. And then, the code is very short, very simple. I'm just going to define my logistic regression, my object, and then I'm going to fit only the training data. So the training features, the X's, and the training target. And then I can predict the outcomes. So if I do this, I can actually get the accuracy of this model is 51% compared to my baseline of 50.56%. So you can see that accuracy improved. It didn't improve by a lot, right? But even that might be sufficient to make money. Even if you have this 0.5% gain, and if you're trading every minute or every second, the odds are stacked in your favor. So you are able to make a lot of money into that. Want to see what coefficients are the most important? I can plot the coefficients from my logistic regression. So these are these betas here that scale every feature. So a positive beta means that if that feature, in this case, for example, if volume is high, it means that the next return is more likely to be positive, right? Because think of it as momentum, as sentiment. People trade a lot. And in this particular data that we had, it was a positive momentum period for silver. So if you see a lot of volume, return next period are more likely to go up. If you see that the 5-minute past return, lag return, if the return was high in the past 5 minutes, that also predicts that the return is going to be positive going forward, although that might not be the same for like other lags. All right, so we have some coefficients. We have trained our first machine learning model. So before we run a horse race between multiple machine learning models, I'm going to introduce another one, which is a decision tree. So a decision tree is a bit more human than this logistic regression function, right? And it goes a bit closer to how we think of LLMs and how we think of AI. So rather than having this rigid mathematical function that we're trying to fit in the features and get some probability, the decision tree asks a series of yes/no questions. For example, is the lag return larger than 50 basis points? If yes, then go to the next question. Is the booking balance larger than 0.1? If the answer is yes to that, you predict up. Otherwise, you predict down. Right? So you have all this series of hierarchical yes/no questions that are going to guide you through making a prediction. And why do I say it's more human? Because I think that's how a lot of us make decisions, right? I don't know, we were trying to decide whether to give a credit or not to a client. If you work in a bank, you're going to open the file and you're going to think, okay, what's the most important variable? Maybe it's income, maybe it's credit score. You're going to look at that, and if the income is below, I don't know, certain level, $10,000 a year, you're going to say no, definitely no. I'm not even going to look at anything else. I'm just going to close this file. If the income passes whatever threshold you have in mind, then you're going to look at the credit score next. And again, you're going to make a yes/no decision. So it's the sequence of iterative decisions that matter in a decision tree rather than having a rigid mathematical model using exponential functions and whatnot to model probabilities. Now, of course, there is a question of what are you looking at first? Are you looking at the return? Are you looking at the booking balance? Are you looking at volume? You don't have a prior on that. You do not have a series of what decisions should you consider first, and you don't have a sense of what the thresholds should be. So what the training model, what the mathematical model does is try to decide what variables you're looking at, in what order, and what thresholds should you consider for the yes/no decisions. So that's what the decision tree does. at the bottom. And again, there is a built-in function that does all this heavy lifting for us. So for example, I can define here a tree, maximum depth of 4. That means I make at most 4 decisions. Whenever I make a decision, I want to have at least 50 observations within one branch of the tree. And you have to define a criterion. And the criterion here is for what reduces uncertainty. What's my measure of information? I want to make these decisions in such a way that I reduce the uncertainty left in my data, that I can tell with greater confidence when the return is going to be up and when the return is going to go down. And then I have to define a mathematical criterion for uncertainty, which in this case I selected to be entropy. But there are others that can be used. And again, in this master's program, we're going to go very much in detail about how to measure uncertainty in various ways and what implications that does it have. So let's test this. Let's run it. And you can see here, I'm doing much better. My accuracy jumped from basically half to 52%, which if I look at the logistic regression, that's only 51. So the decision tree, sort of this more a human machine learning algorithm, if you want, it performs a little bit better than the logistic regression. That's not, a universal statement. I've definitely seen cases where it's the other way around. But in this case, it seems that my prediction power went up quite a bit. And you can even visualize what the decision tree will look like. Again, there's a standard function in Python that will do that for you. So these are the set of decisions, right? We program it to have 4 consecutive decisions. Example, first you ask, is the return from 2 minutes ago below 0.19%? And if it's not, the next variable you're looking at is the booking balance smaller than 0.06. And if the answer to that is yes, then you are saying, well, I predict an up return. If not, you predict actually also an up return. But you have here situations where you predict a down. Right? So the nice thing is that you can visualize this and you can have an idea if it makes sense. Right? For example, if the return is not low, if it's higher, then it's more likely that the next return is going to be higher as well. And here you don't have coefficients to look at, but you can look at feature importance and you can see which of these variables we use is the most important in explaining returns. So for example, here the second lag return is good, the booking balance, or the one we just discussed. And for example, the volume, the actual volume, it's not informative at all. All right, we have 2 models. We estimated them. Which one is better? Which one can help me make more money, right? So we need a measure of evaluating that rather than just estimating that. The first step in evaluating this model is looking at something that's called a confusion matrix. And a confusion matrix is actually a very simple object. It's a 2x2 matrix that compares the actual values of the next return with the predicted values of the next return. And you have 4 categories. You have the true positives, when you said that the return went up and it actually did. True negatives, when you said the return is going to go down and it actually did. So these are the times when you're right. And 2 times where you're wrong. The false positives, when you predicted the return is going to go up, but it actually went down. And false negatives, when you predict the return is going to go down, but it actually went up. So every decision that you make, you can put in one of those 4 buckets. 2 when you're right, 2 when you're wrong. And these are usually on the diagonal. In this particular case, it's going to be this diagonal of the matrix. The higher the number is, the more blue it gets. So you want to see a lot of blue on the diagonal and a lot of white on the off diagonal. This is my color scheme here, because this is the times when I was right. I predicted up and it was up, or I predicted down and it was down. And these are the times when I was wrong. But this is not, you look at the numbers of the diagonal, you look how blue it is. You can look at the accuracy. But the accuracy is not everything. Because what you're looking at is not a model that you're right a lot of the time, because you can be right a lot of the time because the data is very skewed, but a model that's actually very much able to discriminate between times when returns goes up and returns goes down. So even if it's like 1 in a million chance that the return goes down, you want your model to pinpoint that. Not just to say, well, it's almost always going up, so whatever. You want to be able to discriminate. And the way this is done, practice, is done with this evaluation tool for machine learning models, which is called a receiver operating characteristic curve, which sounds a bit like a mouthful. But again, it's a very intuitive concept. So here on the X, we have a diagonal line. And the diagonal line is essentially a random model. So here is the true positive rate, the y-axis. We're plotting it against the false positive rate. So think you're here. Here, you're basically saying all the returns go down. This is your prediction. It doesn't require any data. You're just a very pessimistic person that says all return always goes down. In which case, your true positive rate is going to be 0, because you're never right when the return goes up. But also your false positive rate is going to be 0. You're never wrong when the return goes down. But that's not really using the data in any way. They're just coming up with an arbitrary rule. On the other hand, we have here the point at 1, 1, where you're a very optimistic person and you say, no, the return will always go up. Which means you're capturing all the times that the return does go up. So your true positive rate is 1. You never miss one of those times. But also your false positive rate is 1, which means you're wrong every time the return goes down. You always said it's going to go up. And again, that's not a good way to use data. It's basically a data agnostic rule that you have in your mind. And every point in here is basically a random choice. For example, here I would say 50-50. I will toss a coin and tell you if the return goes up and down. Again, I'm using a rule. I'm not using the data. I have 0 prediction. Now, what would be the perfect model? The perfect model would be a line that goes straight up and then all the way to the right. Essentially, a model that will have a true positive rate of 1 and a false positive rate of 0. You're right every time the return goes up. So you capture all of those times. And you're never wrong. You never do a false positive. Every time it goes down, you know that it goes down. You were never wrong in that. So some smart people felt like, okay, if the random model is just a diagonal, and the perfect model is a line that goes straight up and to the right, then maybe I can assess the quality of the model by looking at the area under the curve. So the area under the curve for a random model would be 0.5. For a perfect model would be 1. So every model you can use will have an area in between 0.5 and 1, in between just guessing and having perfect hindsight. And in our case, our models, if you plot that, true positive against the false positive rate, you can see they have areas under the curve. Again, these are computed by automatic functions in here, of 51 and 53%. So they're slightly better than random, right? It doesn't give you, the markets are still pretty efficient. You're not living in this world where you can really predict with high confidence what what the price would have done. But you're not random either. You're using the data somehow. You're better than a monkey throwing darts by 3% and 1%, right? And the first glance would be like, oh, this is very disappointing. Just about 50% is not worth it. And that's not really the case. So markets are efficient. You can't get huge alphas just by looking at past data. But if you have this very tiny gains and you apply them consistently over long periods of time, then you can make money. Third, this is a toy model. We are trained it over 2 days of data with 10 variables. This is, not at the complexity and at the level of Citadel and Virtue would do it. So they would probably get much better score. But even in this very tiny example that we were able to run in half an hour, we can get some gains, right? And if we use more complicated features, we can get even better gains. So now, the proof is in the pudding. So I showed you a bunch of machine learning models. Can you actually make money? And I'm going to show you that you can make money a little bit. So I'm going to compute my P&L. I'm going to compute my profits by trading. Let's say they're trading at the trade price. Every time my model predicts the next return is going to go up, I'm going to buy. Every time my model predicts that the return is going to go down, I'm going to sit put, and I'm going to benchmark this against buy and hold. We're just having the data clean. And if I run this, I can see my green line here is the buy and hold, which would have made maybe 4%. The logistic regression actually didn't make money compared to that. But the decision tree, which had clearly a better accuracy and clearly a better area under the curve quality, actually made 6% compared to 4%. So I can increase my return by 50%, right? Going from 4 percentage points to 6 percentage points over a period of 4 days by using this very, very simple, very, very tiny model. All right, this is a lot of information. I hope it's useful to give you a taste. My course, and I think a lot of the courses in this master's program will go in detail and try to unpack all of these elements that we've been discussing, right? How to create features, how to load and process the high frequency data, how to look at various models and how to actually evaluate them in detail, and what do they mean, what happens behind the scene rather than just loading them from Python. And then, we can go to more sophisticated models, neural networks, gradient boosting, random forests. There's data out there that's not necessarily on Data Bento. You can use natural language processing, the kind of stuff that LLMs are doing to analyze news and to extract quantity information from news. A lot of hedge funds use satellite imagery, for example, looking at the footprint outside the Walmart to see if there is demand for Walmart products, social media analysis, and then you can combine this with various risk management and combining signals across different assets rather than simply looking at silver futures, what we did today. But yeah, that's what I had, and I hope this is useful for everyone. I hope this is interesting. I'm looking forward to seeing a lot of you in the master's program. Thank you.
Thank you so much, Marius. And thank you, everybody, for joining in this lecture. I do want to have a few closing remarks. we have a few events coming up. I'm just going to share my screen on that. We do have a graduate programs open house that is going to be happening on the 28th of Feb. This is going to be really interesting. We have some more lectures in fintech and cryptocurrency, blockchain technology coming up. So this would be really interesting for you to attend. We'll also send you an email to everybody who's attended this with a recording of the lecture and other resources. But the graduate programs open house is an excellent opportunity to meet with the graduate recruiters, to meet with the professors, to meet with the leadership team here at the university at the Haskayne School of Business. So I would definitely tell you to take some time out and come for that. But we also do have many virtual events as well. We have an application tips and tricks event coming up on the Feb 18th, and you could also scan the QR code at the bottom of your screen if you would like to know more about the other events and future lectures that we would be having. I would also share some of our emails. If you have any questions with regards to this lecture, any questions that you would want to also direct at Marius, please email us on m.fin@ucalgary.ca. This is just some of the other recruiters, including myself and the programs that we represent. You can note down our emails if you would like any further information. But thank you once again. Thank you, Marius, and thank you everybody for attending this event. If you do have any questions that you'd like answered now, just with regards to the Master of Finance program, you can put it in the chat, you can email us, and we're really happy to get back to you as soon as possible. So thanks, everybody, and let's keep in touch.